They basically sat behind the scenes, found out all the public addresses, reverse engineered the private keys, and then in a single night, sent hundreds and hundreds of transactions from all of those wallets, draining them all. At the time, $3.5 billion was lost, and no one was aware of it for approximately 4 or 5 years or so. Billions of dollars are still hacked all the time. So we see this as effectively one of the most important unsolved problems, and that's what Circuit is built to prevent and to solve.
Meet Harry Donnelly, CEO and co-founder of Circuit, the company making digital assets recoverable. Harry explains why he sees a foundational vulnerability in Web3, the fragility of private key-based recovery. In this episode, you'll learn about how we can prevent multi-billion-dollar hacks from happening, how you can secure your wallet, and why Circuit is using automatic asset extraction, his unique solution designed to ensure digital assets are truly recoverable. It's just mind-blowing that these simple hacks just happen on a weekly basis, I feel like.
I think to date, people estimate around $350 billion of Bitcoin has been lost due to people losing access to the funds due to loss of private keys.
What if someone is having a gun to my head?
The reason is that you will lose all of your crypto all at once.
Before we continue, I would like to ask you for a favor. New Era Finance is designed and started to educate you about the future of finance. And I think that blockchain and Web3 is going to rebuild everything that we know about finance. And that's through those guests and the in-depth conversations that we have. However, more than 80% of you are watching this without being subscribed. And if we get more subscribers and more views, and we can start building this community, we can get better guests, we can improve the content, and we can start building. And in that way, we can start educating you even more. So I would like to ask you for a simple favor to check whether you are subscribed. And if you're not, please do, so we can start and continue to build this channel towards a bigger channel to help you all. Thank you very much and enjoy the episode. Welcome to the show, Harry. You've had a very interesting journey. You're a very young guy still. You're building a security company. In that regard, what's the most interesting news from the past few weeks that got to you?
On the security side?
Yep. Could also be on the trading side, but security side, of course.
Yeah. Well, look, first of all, thanks for having me, Michael. Appreciate it. Looking forward to being on the podcast. One of the interesting things that recently popped up, you might have seen it, Arkham did a big announcement on the biggest hack ever. And this had been sitting there for years. Bitcoin, which is now worth $15 billion, had been stolen from a Chinese mining pool. And it hadn't really been picked up widely to date. And so I thought that was really, really compelling and interesting because surely billions of dollars of Bitcoin don't go missing or get stolen on a regular basis and people aren't aware of it. And it turns out, yes, actually, there was only a few kind of technical blog posts which had picked up on this as being taken or being stolen. They weren't entirely sure. And then Arkham did a big public announcement and suddenly the entire world was aware. And so I thought that was incredibly interesting because we talk about crypto as safe and secure and transparent. And in this case, you know, at the time, $3.5 billion was lost and no one was aware of it for approximately 4 or 5 years or so, which is pretty incredible. So I thought that was really interesting. I did a deep dive into it. I wrote a blog piece on it, kind of diving into the technical details of how it happened. And I thought it was really fascinating because it's a really good lesson for what could go wrong if you're using insecure cryptography in setting your private keys up.
Well, I have completely missed this news item. So what has happened and how did they get the, 15 billion?
Yeah. So what happened is that in essence, a Chinese mining pool called Lubian had constructed their private keys using a specific pseudo-random number generator. So as part of the process, you kind of put in these random numbers to seed the private key. But the random number generator they were using wasn't actually random. It took the timestamp from the computer. And so given you know that the timestamp can only be a certain range of values, it changes the entropy or the randomness from an enormous number, more than the grains of sand in the universe or the number of atoms in the universe, to a few billion possibilities. And so because computers today can go through that in a few hours or a few days, really, it meant that hackers were able to reverse engineer the private keys from the public addresses that the Bitcoin mining company owned. And so what they did that. They basically sat behind the scenes, found out all the public addresses, reverse engineered the private keys, and then in a single night, sent hundreds and hundreds of transactions from all of those wallets, draining them all. $3.5 billion was lost in about 2 hours, and it wasn't picked up on because the mining pool didn't announce it. And so I can imagine at the time they were like, what happened? We had enormous amounts of Bitcoin and it's all disappeared. They didn't talk about anything to anybody. They shut down quietly. What happened at around the same time is that the Chinese government cracked down on Bitcoin mining and Bitcoin in general and said it was illegal. And so people said, okay, makes sense, they shut down. It was regulatory pressure. But it actually wasn't. It was, in fact, that they had lost all of their money. It had all been hacked and no one had picked up on it. And so that was a really, really interesting incident because no one had found it. No one was aware until, I think, the start of August. It was publicized more widely. A lot of news outlets picked up on it. And I went deeper into it to try and understand how it actually happened. And so it was a really, really interesting case.
It's so impressive that this keeps on happening. I'm in a space for 8 years, and it's just mind-blowing that these simple hacks just happen on a weekly basis, I feel like. But I've seen that you're a trader yourself, or at least a trading background.
Yeah.
So how do you see the markets or this cycle right now compared to the previous cycle in terms of behavior of Bitcoin and ETH and the altcoins? It seems to be a completely different cycle. Am I correct on that?
I think so. So I'll give context. My background is in trading. So I originally effectively wanted to be a quantitative trader. I did my undergrad degree in economics, finance, math, stats, taught myself computer science, went to MIT, was very interested in financial engineering, which is what I did my master's in, and spent all my summers in different trading floors. I worked for Morgan Stanley, worked for JP Morgan. I did emerging market exotic options trading. And that was originally what I wanted to do. And I was like, oh, this is fascinating. I get to predict where numbers go up and down all day. But I also found out about DeFi at the same time. And I was like, oh, wow, this is even better. This is even more incredible and more interesting. And I see this as the future of finance. This is what I need to do. And so I went effectively from trading, which is a lot about managing risk, to actually going into the technical operational details of how do you remove risk. And so now I'm kind of sitting almost like a layer or two underneath of figuring out how can you prevent losing all of your money at once? Not from a trading loss or going down 20%, but 100% of your money disappearing due to a hacker, or you losing access or losing access credentials. So I would say my trading knowledge is a little bit rusty as compared to how it was. But my take is I do, from where I am, get to sit and speak with a lot of institutions thinking about entering the space and actively in the space. And there is a widespread recognition from them that now crypto is safe to move forward with. And when I say safe to move forward with, I mean from a regulatory perspective. So if you're a large institution, you're a huge custodian, you're a huge bank, the biggest risk for you isn't actually losing a few $1 million from losses due to trading. It's actually that the regulator will come and penalize their entire business line and fine them hundreds of millions of dollars for doing the wrong thing. And that's been the case effectively forever to date, where they weren't certain about what they could do or what they couldn't do. And now, because of the new regime change in America, everyone is effectively getting the green light. They know they can move forward. It's the red carpet is being rolled out. We're seeing executive orders from the White House, guidance from the Fed, the OCC, the FDIC, the SEC. Everyone is effectively saying crypto is good to go. And so now it can actually really be taken seriously. Now they can actually deploy capital into the space, and you're seeing widespread kind of rollout of the digital asset treasury companies. You're seeing massive uptake of the Bitcoin ETFs. And you're seeing all of these other companies, which some are announcing, some are not, getting their custody operations set up to hold Bitcoin and hold crypto and Ethereum and other altcoins as well. And what's also happening in parallel, which is less trading related, but is also kind of similar, is that stablecoins are taking off. Everyone is now aware that stablecoins are kind of the new wave. They are going to revolutionize payments. They're going to make everything better, cheaper, and faster, which they are. They are actually a fantastic technology. But from an operational perspective, the same infrastructure and the same technology that all these companies need to use to set up stablecoin payments is the exact same that they're going to use to accept crypto and to buy crypto and to sell crypto. And so stablecoins are almost kind of like the stablecoin mullet, where Stablecoins are the gentrified version of crypto, which institutions can say, yes, we're going to use stablecoins, and everyone says that's fantastic. But it allows crypto to come in the back door because, oh, well, we've already built the infrastructure. We can already custody the technology. We may as well do this as well and offer it to our users. So you have these kind of parallel waves of price appreciation, institutional adoption, stablecoin adoption, plus regulatory regime change, which allows businesses and institutions to actually get involved properly for the first time, which is what I see as the difference from previous cycles. Was that before, you'd have a few kind of leading edge hedge fund maverick types, and that was really it. There wasn't really anybody else who wanted to fall under official regulatory regimes with lots of capital, particularly in the US and Europe, who were able to hold it on balance sheet, who were able to purchase it in bulk. And now it's actually possible for effectively any company now in the world to hold it themselves without any issue, either via ETF form or by holding it on their own balance sheet by setting up custody operations. So that would be the big major difference, I would see.
Yeah, I agree on that. I think this cycle has more to do with the 2017 cycle in terms of adoption than with the previous cycle. The previous cycle didn't really change much. We had a lot of like new copycats that are going to solve Ether, and that was basically it. Yeah, of course. The first run of DeFi, NFTs, Metaverse, they all came along. But this cycle, we really see a whole new group of investors coming in, which are the institutionals, especially in the US after Trump got into the office. For the audience, how much has that changed for you as a company with the green light in the US in terms of, well, recognition or adoption or potential business cases? How big is it?
It's enormous. There's no real way of understating it, is that ultimately you now have the US, which is the home of capital markets, where the vast majority of assets are custodied and held and trusted globally, now able to accept crypto without issue. So we're moving from a world where regulatory risk is the biggest problem to the next step, which is operational risk. I like to bucket the world into, if you're thinking about setting up, it's regulatory risk, operational risk, price risk. And most people, when they're focused on crypto, think about the price risk. It's like, oh, it'll go up and down quite a lot. There's a lot of volatility. But if you're a business or an institution, that's actually the last thing you think about. The first thing you think about is, will we get fined or will our existing business get shut down? From a regulatory perspective, we get involved. And that's now been solved. You don't have to worry about that anymore. The next step is, if we get involved in the space, can all of our money disappear at once? Because then that's a massive issue that the customer's funds will be taken, and also reputational damage that, hey, we're not secure. People might look at us and think our existing business is in jeopardy, or that we shouldn't be custodying our funds with these people and it's a massive loss of trust. And so you need to solve that, and then you can get to the price risk. And ultimately what Circuit is doing is we're focusing on operational risk. We want to remove catastrophic losses from happening in the space. And what has happened is that now that regulatory risk has been solved, it now moves everybody to thinking about that next step. And that's exactly what we do. And it's a wonderful, wonderful time for us because we're solving a problem that couldn't be solved before in a very unique way, which is really compelling to these institutions. And now is a wonderful time for them to be starting to roll it out and get organized and set up in the space. So I'd say ultimately it's kind of transformative for our business. It increases our potential addressable market dramatically because every bank effectively worldwide is now going to be starting to think about this. They are kind of almost the perfect use case to apply our technology, as well as every other institution who's trying to enter as well.
If we've been talking about Circuit for a little bit, but if we would like to hear an elevator pitch of what Circuit is doing, what would you say?
Circuit is focused on removing and preventing catastrophic operational losses. The reasons that you will lose all of your crypto all at once is why we are doing what we're doing. What we built is technology which we call automatic asset extraction. And that focuses on protecting your assets without having to take control of your private keys. And we focus on two major things: loss of control or loss of access. So that can mean losing your private keys, losing your access credentials, your bank, your custodian going down, downtime from those providers, basically any reason you would lose access to your funds, or loss of assets themselves. if someone steals your private keys or someone steals your access credentials or someone's able to get multiple members of your team to coordinate to try and steal all your funds, these are the reasons that you lose all your money all at once. And that's what Circuit is built to prevent and to solve. And we work with major custodians, major wallet providers, and major insurers to connect all of them together to prevent these losses from happening and make it cheaper and easier to get insurance to totally protect your funds as well. So we see this as effectively one of the most important unsolved problems. We just talked about it, billions of dollars are still hacked all the time. And if you can prevent that from happening, it means the space is now much, much more investable and it's able to get much, much wider adoption. And that's why we're doing what we're doing.
Well, if we talk about billions of money being hacked or disappear, we also have the case of James Howells, who had 8,000 Bitcoin disappear from a hard drive that he tried to recover, but it didn't really work out in the way that he wanted it to. Could Circuit actually prevent a case like this of happening, and how?
Yeah, so Circuit could have prevented it if it had been set up ahead of time.
Fair enough.
What James Howell did effectively, for people who don't have context, it's a famous case where a guy had his laptop thrown out, which contained the password or the ability to get into now $800 million worth of Bitcoin. And he's been fighting for years with the council in Wales to try and get access to the rubbish dump to allow him to gain access to his laptop to try and get the Bitcoin out. And it's become very widely publicized, and there's been all sorts of kind of interesting twists to it, like a hedge fund coming in and agreeing to take a stake in it. And now I think he's trying to release a token representing the claim on the assets themselves. But ultimately, there's now close to $1 billion, which was just thrown out in the rubbish, and no one can access it because the private keys have been lost. And more broadly, it's a massive problem that lots of people have faced. Lots of private keys have been lost. I think to date, people estimate around $350 billion of Bitcoin has been lost due to people losing access to the funds due to loss of private keys. And right now, there's nothing you can do about it. Effectively, once the private keys are gone, they're gone. You can't sign a transaction, you can't move the funds anywhere else, and they're inaccessible. And so what Circuit does is we say, okay, what are the important things here? Is it the private keys or is it the assets themselves? Ultimately, it's the assets themselves. You want to protect the assets. And so we focus on allowing you to always recover the assets without having to touch the private key. And the way we do that is by focusing on transaction layer security. We create, store, and manage pre-signed transactions. So think of these like pre-approved blockchain instructions that allow us to move the funds to a preset backup destination. So whenever you sign a transaction, you'll sign it and then it goes on chain and it's broadcast. Think about what we're doing is we're separating out those two parts. We're signing something, but it's not being broadcast. We're holding on to it to be able to use it at a later point in time. So in the case of James Howell, he would have set up Circuit ahead of time. We'd have created pre-signed transactions to enable him to move his funds to a backup wallet. And whenever he lost access to that wallet, he'd be able to move the funds to the backup wallet using Circuit, even though he'd lost the private key and lost access to the original wallet. And so this prevents that catastrophic event from happening, that even if you lose your private key, even if it's thrown out and the hard drive isn't available, you still have the ability to always move the funds out. And if you're an institution, it's effectively the same thing. It means that even if your custodian goes down or your wallet provider goes down or you're not able to access your funds, you can still get those funds out. And so that's kind of a breakthrough ultimately, is you don't have to trust whoever is holding those funds without having the ability to move them yourself unilaterally. Because ultimately that's what blockchain was set up to do, is don't trust others, self-custody yourself. But for a lot of institutions, it's not really possible. Ultimately, in certain cases, it's written into the rules of how they're set up that they need to custody with other third parties. But what we're enabling is you can actually both custody with third parties, but not totally rely on them. You still have the ability to get those funds out in the worst case scenarios where they go down. So we think it's both an innovation from a technology perspective, but also aligned with the ethos of the space, that it enables you to always remain in control of your funds, even if you give them to third parties to control and to protect.
Well, isn't that like I'm in the space for 8 years, and I've been a retail trader.
Yeah.
Right now, we are an institutional trader. We have the fund, we have the venture capital. So custody is for us a very important topic, which, if you look at it from the scope of being a Web3 degen, they all claim to be very much into the self-custody aspect, but society is not really built on self-custody at all. Like, we all use banks, we all use entities for our services or our assets because we don't have the responsibility for self-custody at all. It's not being taught. And what now is being built is that you can use multiple people, and then you have certain phrases of the seed or certain phrases of the private key to connect to the wallet, which, in your opinion, is having a lot of vulnerabilities. Am I correct on that?
Are you talking about multi-signature wallets?
Yes.
So multi-signature wallets are better than just blindly holding a private key.
For sure.
But like anything, there's no one silver bullet. Multi-signature, if we take an example, there's 3 people. 2 out of the 3 people need to come together to sign a transaction. And then only when 2 of 3 people come together can the funds be moved. The issue is, ultimately, 2 people are still susceptible to colluding. So they can come together and say, actually, we're going to move it without the knowledge of the third person and take all those funds. Or they're vulnerable to being threatened. You could just find 2 different people and say, hey, we're going to hit you on the head with a wrench unless you sign it for us. So there's still always the ability to take funds out, even though you've distributed it. So it's definitely a step up from saying, hey, we're blindly holding the private key in raw form. We've now moved it to a multi-signature wallet. That's great. The next evolution from multi-signature wallets was MPC wallets, so multi-party computation. What they did is almost effectively similar to a multi-sig, but instead what they do is they use cryptography to almost effectively magic mathematics to chop the private key up into different bits, so that even if the 3 were brought together or 2 were brought together, it doesn't give you any more information about the entire private key. But still, like anything, it's still vulnerable. If you lose access, you can't sign anything. If 2 of the 3 people lose access, you're still not going to be able to move the funds. And if someone steals credentials, so if someone is able to take the credentials that were able to sign it, they'd also be able to steal the funds. And so this is where Circuit steps in, is that even in that worst case where they lose access for any reason, you're still able to get those funds out. And the next product that we're building is that even if, and about to release pretty shortly, is that even if someone steals the credentials or steals a private key, we'll still be able to recover those funds in the majority of cases.
I'm going to ask some questions on that particularly because it's an interesting inverse way of thinking about security that we haven't been doing for a long time. But before that, you recently raised a 4.5 million seed round. First of all, how was it to raise in these current markets?
Yeah, we did. So very grateful to the investors who came on board. For this, it took place relatively quickly. So what we did is we set up conversations with lots of different investors. I'm very grateful and thankful to have lots of people who wanted to help and put us in touch with different people. So we had a lot of conversations over a relatively short period and found Nyka, who was our lead investor, who was a very good fit. So what Nyka do is that they invest generally in kind of fintech specific companies. And so a lot of Web 2 companies, but also Web 3 companies like Zero Hash, they've invested in Gemini, they've also invested in Revolut as well. And they're very focused on saying, how can we bridge these startups to the institutions, the major financial institutions in the US? And one of their theses is that digital assets is going to be adopted by institutions. And in order to do that, the security and the infrastructure needs to be put in place. And so they saw us as a very good fit for that. Ultimately, we're building critical infrastructure to enable institutions to enter, and it just aligned really, really well. And then once we had Nyka on board, it was possible for us to get several other funds and several other angels aligned along with them. And we ended up with a kind of fantastic round where we have 7 VCs total, Nyka being the lead one, as well as more than 20 different incredible angels from places like Citadel, JP Morgan, Galaxy, FalconX, Meta, and more. So really like a stacked group of people who are executives and decision makers and connectors and helpers who are seeing the value in what we're doing and try to help us win. So very, very grateful for that.
It's impressive because nowadays the VC market, it's more focused on token VC rounds. They are quite bad at this point. The markets aren't in the best shape. So huge congrats for you of raising the seed round. My question is then, how is that going to accelerate the entire growth path of Circuit?
So it's already accelerated it enormously. What money allows you to do mainly is to hire really, really good people who are expensive at the end of the day.
Fair enough.
And we've been able to bring on some fantastic engineers. The latest engineer who's going to be joining us, he went to Cambridge, he did mathematics and physics at Cambridge, then he went to a major crypto exchange and built their internal custody division from the ground up, and was also involved in their high frequency trading and making that more latency sensitive. And he's going to join us next month because he just saw all the same problems that happened when he was building the crypto custody internally. And was like, okay, this is a massive problem that needs to be solved. Saw the depth and the smartness of the rest of the team and is like, this is a great team to join. So we have really great group of people who've been brought together. And once you have a great group of people, it starts to kind of take a life of its own, and they're able to organize and self-organize and do their own things, and then attract more great people. So I'd say that really is our main use of funds, is to hire really great talent to enable us to get to the next step, both in the engineering side and both get in front of more and more people, as well as bring on incredible advisors who are helping ultimately upgrade and accelerate us as well. So main use of funds is just basically people, and that's helping us get to that next stage.
I mean, if you hire great people, they will hire great people themselves. It's a common thing. When we talk about attack, I mean, we have a little bit been going into your way of thinking about security and basically having access to assets instead of using it by a private key. One of the things that Circuit has developed is the automatic asset extraction, which is something new. And for the audience that is listening, what is it? Can you walk us through it?
Yep. So automatic asset extraction is the engine ultimately that Circuit's platform is built on top of. And what we do is we, as mentioned, focus on the assets, not private keys. And so we create, store, and manage pre-signed transactions, these pre-approved blockchain instructions that allow us to move funds to a preset destination at a later date. And so an analogy I like to use, and I think I used it on a previous podcast, is that every time you want to give a letter to the blockchain, you need to stamp it. So imagine you have a big stamp, it puts a specific stamp for you, and then the blockchain will take a look at it and say, okay, great, the right stamp is there, I'm going to send it and move it off to somewhere else. The private key is like your stamp, that if you stamp it, it'll say, okay, this is the right stamp, we can move it off. If you lose the stamp, there's nothing you can do. You're not able to send letters, and so no funds will be able to be sent. What Circuit does is we create all these pre-stamped letters. We're creating all these letters which have been pre-signed, pre-approved, to allow us to send them and to have them accepted by the blockchain at a later point in time, and without you having to worry that they're going to go somewhere they're not supposed to go. So think of it like the destination is already written on the letter, and Circuit can't change it. And this is exciting because it almost makes it idiot-proof in a sense, is that you don't have to worry that we're going to take your funds or move them somewhere they're not supposed to go or do anything with them. If Circuit tries to alter it, it's just not going to be accepted by the blockchain. They're going to say, no, we can't accept this, it's been tampered with, and not approved. And so instead of having to entrust your private key to a third party or entrust key shards to a third party, all you're doing is just giving us these instructions which we can hold and encrypt and store for you to be used at a later point in time. And so the different applications for automatic asset extraction is the first one, the manual version. Think of it almost like a red button. If you're a fund manager, what's one of the worst things that could happen is that your funds get trapped, that you lose access to them and you can't do anything. Circuit gives you the red button you can press to always get your funds out, so you don't have to worry about someone taking access to them or you losing the ability to move your funds. And a great example of that is during Terra Luna, I knew an asset manager who was using a major wallet provider and it froze. And he was basically frantically pressing the button and trying to withdraw his funds, and it wasn't working. There was rate limits, the wallet provider wasn't responding, And he basically watched his entire fund go down to zero without being able to take any action. And so that's almost a perfect example where the red button would just enable you to always get your assets out. Even if the provider isn't responding, even if the custodian isn't working, even if you've lost access, you always have the ability to recover your funds. So that's application one. The second application is automatic, is that in crypto, attacks can happen in as little as 4 seconds, basically start to finish. Humans can't respond to that. You know, me and you sitting here, we're going to get a notification. Maybe we're on the toilet, maybe we're at dinner. We're not going to see it in time. And particularly when we talked about the multi-sig wallets or the MPC wallets, there's not just going to be one person, there's going to be multiple people. And so every time you have more people involved, there's an additional communication barrier, there's an additional latency barrier, and it just means that the response window just increases. And because attacks are happening so quickly, it's almost effectively impossible in certain cases for humans to respond. And so what we've built is the ability to not just press the red button, but to be able to do so automatically. That you can automatically sweep the funds to a backup wallet in the event that an attack is detected without having to coordinate people in time. So because attackers are moving at machine speed, this allows the defense to move at machine speed as well. And so those are the initial two applications that we've built, is that we have the ability to help you if you've lost access. So if you've lost your private key, you've lost credentials, wallet provider's gone down, you can manually press the buttons, extract all the funds, or you have the ability to automatically do it. That either you can use an external signal that says, hey, a hack is happening, or we have some signals ourselves which would enable us to say, hey, this is something you should look at, to then automatically move those funds to safety before the attacker is able to get to them. The analogy I like to use is, imagine your wallet provider, your custodian, is like a vault. And you keep your crypto in a vault, and it's great. It's a very safe, secure vault. But what happens if you lose the key to the vault? Well, the vault's going to be locked and you're not going to be able to get into it. It's such a good vault. So you're kind of stuck. And the second is, what if someone steals the password or steals the key to the vault? Well, they'll just walk up to the vault, open it, walk in, take all the funds and walk out. And because it's digital, it just happens instantly. And so what Circuit is almost is like inside the vault. If you've watched Mission Impossible, it's like all these red lasers which are crisscrossing inside the vault. And if someone walks in without authorization, it triggers it. And then an escape hatch opens up underneath the funds, moves the funds to a different backup vault, and they're safe and secure in there. And so the attacker's walked in, but there's no funds left. And so it adds this additional security on top of your custodian or your wallet, which wasn't previously there, and means you don't have to replace your custodian or your wallet. So that's a big point of friction we see with institutions, that ultimately they're not going to rip out their entire infrastructure and start again from scratch. Too much hassle. So we've met them where they are, and we can add this on top of whatever existing infrastructure they're using, but it adds additional safety and security and makes it easier and more possible for them to both, one, have peace of mind, but two, insure those assets. And so insurance is something which, I'll stop now because I've been talking a little bit, but we've spent a lot of time working with and have a lot of knowledge on that I'm happy to expand on. But TLDR, it's very expensive, it's very difficult to get. Circuit makes it cheaper and easier to get with Lloyd's of London insurers.
Well, I mean, I've been taking notes, so I'm happy to ask some more questions on this particular subject, which I think a lot of people will have asked questions themselves. Earlier, you were mentioning that hacks are so fast that we as humans cannot really respond to it. So let's use that as an example. You have security with Circuit. There's a hack taking place. They try to transfer the funds, but you would like to push the red button. How does it work when a hack is taking place and you're not fast enough? How is Circuit preventing you from losing the assets?
When you say you are not fast enough, as in the human, or as
a human, yeah.
As a human. So what Circuit enables is for you to set up automatic triggers to move those funds. So without a human having to be in the loop, you can say if certain conditions are met, so if this happens and this happens, or if this happens, Circuit will automatically move the funds to the backup destination. So with our new product, there's certain criteria we've looked at which we think are very, very important for detecting hacks from wallets, which we'll be announcing relatively shortly. But think about it more generally as there's certain things are certain characteristics of lots of different hacks. Let's say an example is that a wallet which only sends small amounts every day now sends an enormous transfer all at once. That's anomalous. That's an anomalous pattern. Or another would be that a wallet is sending to certain addresses all the time, but suddenly starts sending to a new address which had never been seen before, and starts trying to send a large amount. Or another example would be if it's a on-chain wallet or a non-smart contract, that another smart contract gets deployed which points at that other smart contract. And so it's like, okay, is this potentially malicious? There are certain things you can pick up ahead of time, and there's providers like Hypernative and Cybers and Texigate and others whose full-time role is just to focus on being able to detect and alert you to these situations. What Circuit can do is Circuit can connect ultimately to the detection. Circuit provides automatic response, which we've seen as one of the missing pieces, that we can automatically respond to the detection of these alerts and use that to move funds to safety. So imagine you say, hey, there's an alert. And instead of the alert saying, hey, you should check this out, take a look, someone's trying to steal it, it's move the funds to safety and then figure out what's happening. And that's what Circuit enables, is that without having to have a human in the loop, you can set up ahead of time what I want to have happen if we see this alert occur, or if we see this probable hack, and move the funds to safety so we don't have to worry about it. And that can happen effectively almost instantly within seconds.
What if there's a false trigger? If someone or the parameters are wrong, what then?
Yeah. So the nice thing about it is that it moves from being a security issue to being an operational issue. The funds are just going to be moved to an existing wallet you own. So it's basically going to be moved from internal wallet A to internal wallet B. So it's not going to cause a loss of funds. All it's going to do is just move wallets internally for you to a different wallet in different infrastructure, which is different credentials or security around it. So from a risk perspective, it is much, much better because we don't have to worry about an active security breach. And all we have to worry about is making sure that our operations can continue from that other wallet instead.
All right. And you mentioned Terra Luna before, but we also had a case like FTX, where exchanges are they are quite often doing their custody themselves, or they are using a service provider or custody provider like Fireblocks or Copper or any of those solutions. If you're using an exchange, how can I use Circuit or still maintain access to my assets, or is that just simply impossible?
So it depends on the setup for the exchange. Generally, what exchanges will do is they will have an omnibus wallet or a series of different omnibus wallets. So an omnibus wallet is, think of it like a big wallet where lots of users' funds are pooled together. And from a user perspective, you don't know, if there's 100 Bitcoin in it, you don't know which tenor yours or which tenor someone else's. And the exchange is not going to tell you where that wallet is. And they're not going to say, this is your 10. It's like all of it is commingled. And when you want to withdraw it, then we'll figure it out in extraction and bring it out to you. When it's in an omnibus wallet structure, we can't help the user in that case. But what we can do is we can help the exchange. So what we can do is we can help the exchange protect those funds internally from being attacked or from being hacked or from being lost. So that if someone were to come in and, for example, we take the Bybit case, if someone's trying to steal from internal exchange wallets, we can enable that to be protected versus for the user to press the button. If they're using and this is more institutional, if they're using a segregated wallet exchange product, something like a Copper Clearloop, then it is possible to enable Circuit. But if they're using an omnibus wallet where funds are commingled, so if lots of money is being put together and you're not sure which is yours and which is someone else, then it isn't possible for Circuit to work, mainly because the exchange doesn't want to say, hey, this is your $10 in this wallet, and this person's $20, and this person's $10 million. It's just kind of really operationally difficult.
I get that, yeah. So maybe exchanges need to be rebuilt then to be making sure to get some more risk being covered.
Possibly. It depends on kind of what you think about from an exchange perspective. If you're thinking about let's just protect against the risk, then Circuit can be enabled behind the scene for these exchanges. That Circuit can act as an internal operational tool versus an external tool for the users. And if the end result we want is to protect against loss of funds or bad actors, then it probably does actually make sense for the exchange to layer as many protections as possible internally versus saying, hey, user, you figure it out with your own wallet. Because we know historically that people lose their keys. They don't think about it properly. They blind sign. They can be attacked. They can be kidnapped. And so you almost want this third party in certain cases for a lot of users to be able to protect it as long as they're a good actor. And so if you trust the exchange as a good actor and that they're taking every measure possible, then that is a better situation. But if we go to an FTX type situation, then the exchange wasn't a good actor. The exchange was a very bad. The exchange was a very bad actor, and it's a totally different picture and a totally different story. So you have to kind of take your assumption of, do we think this exchange is a good actor, in which case they should be using this internally, or do we think they're a bad actor that we shouldn't be trusting our funds with? Maybe in that case you shouldn't apply the funds to the exchange. If you're a larger user, you can potentially put pressure on the exchange to create a segregated wallet for you, so you can see your funds at all points in time. At that point, Circuit can be enabled, and that would enable you to effectively have the red button. But for individual retail users, it's probably unlikely to happen anytime soon.
I think, given the fact that we quite recently had an interesting case with World Liberty Finance and the execution of a particular investor with the assets of clients, at least there's a rumor on it, it's probably going to increase the subject again of having self-custody. And me as a institutional player myself, I'd rather want to have my assets secure somewhere where we can use account abstraction. When needed, it executes and goes to the exchange, because having third-party risk with an exchange is just way higher for me than having the self-custody and having it properly decide myself. One question on that regard is that you mentioned you can have pre-stamped signatures or pre-stamps, and then you can just easily push on a red button in order to get it executed if you want to do it manually.
Yep.
What if someone is having a gun to my head and they want to press the button, or how does that work? Like, just if it is possible, dive into the red button, particularly on execution, if that's possible.
Yeah. So if someone decides to take a gun to your head, ultimately they're kidnapping you and extorting you, what they're likely to do is to try and get your wallet. They'll get your private keys, they'll say, give us your passwords to your Coinbase accounts, or they'll phish you and scam you and try to move the funds out. That's one of the areas where Circuit can help. Ultimately, Circuit can provide this additional layer of protection on top of the wallet or the custodian, which is watching your funds to try and move them to safety to a backup wallet, which the attackers don't have access to. If the attacker comes to the user and says, okay, Circuit, I want you to press the red button for Circuit, what that's going to do is that it's just going to move the funds to the backup wallet ahead of time. And so the user is the one who sets up the backup wallet. If it's an institution, which we only work at institutions at this point, it's a different custody setup. And that just moves it from safe, secure destination number 1 to safe, secure destination number 2. Circuit can't alter it to the attacker's destination. So there's a lot of, there's basically triple layers of checks between us and the wallet provider, which prevents Circuit from being able to alter where it's supposed to go without the consent of both the wallet provider and the user. So we're working on preventing any single point of failure that even if Circuit is compromised, or even if the user is compromised, that's still not going to be able to move the funds to a malicious destination. And we set pretty rigorous controls and whitelists and immutable policies in place to prevent any bad actors from doing so.
Well, in that regard, I need to ask the final question, which, is just a very straightforward one, which is, great, you're building a new solution for security, which is a centralized company. How can we be sure that Circuit isn't using the data or isn't doing anything wrong with the assets that I have or the data that I have? I mean, you mentioned it shortly already, it's on the blockchain, but how are you making sure that there are no third-party risks with Circuit?
Yeah. So what I think is really interesting about Circuit is that we're setting it up in such a way that we can actually entirely remove any third-party risks, even if you're using centralized parties like custodians and Circuit. And think about what Circuit's trying to achieve when we talked about like removing the problem of loss of access through a wallet provider or custodian. It means that even if the custodian goes down, we're still able to move all of the funds out using these pre-signed transactions. So what we're setting up is that we can allow the user to store these transactions themselves. So if you want to, you can remove both the risk from the custodian by saying, okay, I have these pre-signed transactions which Circuit is creating, storing, and maintaining, which act as this ability to always move my funds to a backup wallet. And then Circuit is giving me the ability to hold them myself, that I don't have to rely on Circuit, that if Circuit disappears in the morning or goes down, that I won't be able to access it. So if you take that, it's like, oh, actually, now, ultimately, for the first time ever, really, you can have the ability to always maintain access and control to your assets, even if a third party is holding them, but without having to rely on that third party or any other third party. And I think that's really exciting because it enables you both to have the safety and security and legal wrapper of we're using a wallet or a custodian without having to have the trust assumptions that if they go down or if Circuit goes down, that I won't be able to access my funds. And so we work very closely with the wallet providers to prevent Circuit's ability to collude or change addresses or to make any alterations and tampering, and then also to set it up in such a way that it's fail-proof, that even if Circuit were to go down or to fail entirely, the user would still be able to extract their funds independently. And so that's how we're trying to get around, is that even though there is a centralized component to it, we're working in such a way that we can enable the user to take true independence and sovereignty over those funds with the ability to take these instructions, these messages, to always move the funds to a backup wallet they control.
You mentioned before that a lot of, well, actually all your clients and partners are currently institutionals. What institutions are most interested right now in a solution like yours? Are these the debt of the world, or?
So we're seeing funds at the moment and custodians themselves as those most interested. So if you're a larger fund, you're going to be managing across multiple different custodians. You're going to be managing a lot of assets on behalf of users. And one of the major risks that is left for you operationally is concentration risk. That if this custodian or wallet provider goes down, my funds are trapped. And yes, diversification helps. You know, it's great to only have 50% or 20% in one wallet, but still 20% or 50% of your funds if they disappear. And that's a massive, massive risk, which you can't really remove at the moment. And that's where Circuit comes in, and we're enabling them to have this, for the first time, the ability to independently move the funds no matter what happens to the custodian or the wallet provider. And they find that very, very compelling because ultimately for them, it's one of the major risks that are left. And so funds, we're now seeing exchanges, we're seeing ETF providers. We haven't spoken to any DATs actually yet, but we'll be speaking to shortly. Seeing the value proposition, because ultimately, if you are in charge of a large pool of assets, you want to remove these risks, and Circuit enables you to do so for the first time.
Well, I mean, it makes sense to go for institutions alone, but there is also a big, especially people who are listening, big group out there that is just a retail investor. What are you going to go into the retail market, or if you're not planning to go for retail investors, why not?
We would love to bring this out to retail eventually. There are certain kind of technology barriers, which means it's a lot easier to do this for institutions, mainly because of the wallet setups and the custody setups that they have. And so there'd be some user experience frictions to set up automatic asset extraction for a retail individual user. But even in some of our testing, we've been using ledger wallets, and we gave out seed phrases on Reddit to see if people were able to effectively take the funds or steal the funds. And it still works. And it's very exciting is that even if you were to give your seed phrase to a ledger and someone was to take it, we'd still be able to recover those funds for you. And so we see that as kind of very compelling. It's almost a wonderful, wonderful use case demo example, which we can give to people. And we may roll it out in the future to select kind of individuals that we work with at these institutions, and then eventually, ideally, a wider rollout as well. But for now, there's a degree of focus. We're still a small team. We're trying to solve this in the biggest way possible. And the most funds are held by large banks, large custodians, large exchanges, large funds. And the way for us to do the most good for the most funds immediately is to begin working with them to showcase that value proposition, to gain that trust, and then to roll it out more broadly across the ecosystem.
Well, if we look 5 years ahead, I mean, Circuit isn't that old as of yet. Neither do we. What role do you envision for Circuit within the entire Web3 ecosystem in the next 3 to 5 years?
So I see Circuit as almost more of a risk company than a security company. And the reason I say risk is that risk is more broad than security itself. We are focused on removing risk anywhere we find it. And the biggest risks we saw initially were operational risks, the loss of private key, someone stealing your private keys, and being able to take all of your funds immediately. And we've now started working with some of the biggest and best wallets, insurers, custodians in this space. And the wonderful thing about that is that we're going to be able to work across industry. So it's almost this horizontal layer that has the ability to work with every wallet, every exchange, every custodian, every asset manager, to then be able to work with them to understand where are their pain points, where are their frictions, what are the other risks that they're concerned about, what are the things that they care about. We've also been spending a lot of time working with insurers and Lloyd's of London, and we think insurance is going to be a major part of the space that hasn't really taken off yet. And part of that reason is that digital asset insurance is very scary. Ultimately, there's these massive losses, there's not much data, and it's a very technical area. And we are beginning to work with some of the best insurers in this space to help them gain more confidence, to remove the tail risks that they're concerned about, to remove aggregation risk and concentration risk. And then by embedding with these insurers as well, this enables us to get a sense of what are they most concerned about. Let's solve that problem too. What are they most concerned about? Let's solve that problem too. So we see ourselves as being this very critical layer, which ultimately, if you are entering the space in the same way that if you're setting up a hedge fund or setting up a business now, you're going to need to have custody, you're going to need to have automatic asset extraction. This is going to be a critical layer which protects against the worst cases. That is going to be used cross-industry, mainly institutional to start with, and then ideally rolling out more widely for everybody to make it safer, more secure, and just possible to gain confidence in the space, so that if we take a look at our buckets we talked about at the very start, regulatory risk, operational risk, price risk, everyone can almost forget about the first two. Yes, we've got the regulatory risk sorted, we have the operational risk sorted, now let's focus on the price and the use case. And then that enables a lot of other people to get involved, to gain confidence, and for the digital asset space more broadly just to take off. And if we go back to when I originally found out about DeFi, I was like, oh my God, this has to be the future of finance. And I do firmly believe that by building what we're building and enabling businesses and individuals to get set up with this, it makes it much more possible for decision makers in traditional finance and traditional industries to actually accept the space and for it to take off in earnest.
Well, I agree. I mean, DeFi is the most exciting vertical or segment of crypto. And I mean, stablecoins in itself are showcasing something that has been existing for nearly 8 years. I mean, stablecoins aren't new. They are new because regulatory risk is removed. If we look at every aspect of the Web3 ecosystem, we have tokenization, we have stablecoins, CBDCs, debt, and all those things. What are the biggest growth opportunities for Circuit?
If we're going to identify major institutional themes, I think stablecoins, tokenization, DATs, ETFs, and the ability now for traditional exchanges to be able to hold crypto and RIAs to be able to offer crypto to their clients are all kind of major catalysts for acceptance and growth of crypto and blockchain more generally. Of those, the places where crypto assets or bearer assets are used are most interesting for Circuit. So this would be for the exchanges, for the DATs, for the stablecoin providers. And then tokenization is an emerging use case where they're still trying to figure out, in certain cases, what's the best structure. Should it be a mint and burn? Should it be a redeem? Should it be a total bearer asset on chain? Should it just be a representation which we hold everything off chain? Once that is firmed and solidified and organized by the largest players, that then enables us to get a better understanding of how Circuit can exactly fit. But we see ourselves fitting across the ecosystem, across all these different verticals. As mentioned, it's a horizontal layer rather than a vertical one to enable all these verticals to take off more safely and securely and almost act as the base that they sit upon.
Let's dive into some other questions, which is usually a little bit more personal. If you look 10 years ahead from now and you have crypto is going to be absolutely phenomenal. What other market is also going to do well in the coming 10 years, in your opinion?
A market which I'm kind of loosely following and I think is really compelling and interesting is quantum computing, which over the next 10 years probably actually intersects quite a lot with crypto. Ultimately, the way we've been doing computing has the ability to fundamentally change from being digital, from being effectively almost deterministic, to moving towards a new paradigm. And the existing methods of encryption that we use often aren't set up for it. So I think that's going to be a fascinating, tremendous shift in financial services more broadly, is that all of the encryption we use to protect everything, all of the money in the world, a lot of it's going to be at risk. And so there's going to be a massive widespread migration. So similar to Y2K, when everyone was like, oh my God, all of the computer systems are going to break because it's going to go from 99 to 00 and everything's going to fall apart. We're going to see the same thing with banks and financial institutions moving to post-quantum cryptography across their entire portfolio and across all of the different systems that they're using. And I think that's a wonderful intersection and interesting opportunity for crypto and blockchain more broadly, because if you're saying, hey, you're going to have to move all of your existing systems to new rails anyway, why don't you just use blockchain? So I think it's an area which has both a catalytic impact for blockchain, that it's saying, okay, we're going to have to move to new rails. Maybe we can use these new rails in post-quantum form, but also just from blockchain is going to have to change things because the way we encrypt things today is also going to stop working. And so I'm much more bullish on the ability for crypto to change quickly and deal with this than for traditional finance, just generally from a speed of movement perspective. But I think it's both really interesting on that side and also more broadly as well. I'm not yet, I would say, super knowledgeable or technical about it, but I think it has really fascinating ways of, if we think about all sorts of problems which involve this massive amount of parsing through lots of data and computing large numbers, it offers a new way of doing so, which in certain cases can be potentially much better and much quicker and open up new ways of thinking about different problems which haven't been approachable before. So that's one industry in one area which I think is quite fascinating and over the next 10 years could be potentially transformative and it will start coming into its own.
Well, I'm very happy that you didn't say AI, because like everybody's saying AI, which is very straightforward. And yes, AI is changing a lot of things, but indeed, quantum computing is a great opportunity, but it could also be a risk for blockchain. There are some articles out there that quantum computing is going to crack Bitcoin. What is your opinion on that? Is it a risk?
It is definitely a risk. I think if we go back to the hack we mentioned, the Lubian hack originally, what ended up happening is that we were able to compute very quickly all the possible ranges of values that the private keys could be to figure out how to hack those addresses. And in a similar way, that's what quantum computing offers, is that if you have exposed your public key online or on-chain, it has the ability to then reverse engineer to extract your private key much more quickly than was originally calculated and designed with how computers or how modern existing digital computers would work. And so people are already starting to work on it. There's a few startups who are thinking about it and thinking about it in a way which both, one, would enable you to move to new forms, but two, be able to bolt on top of existing addresses and on top of existing infrastructure. It's going to have to cause a widespread change, because if you are leaving if you're leaving billions of dollars in addresses which have done lots of transactions and everyone can see the public key associated with it, then that's then at risk. Ultimately, is that you have a ticking time bomb of, at some point, someone is going to be able to reverse engineer the private key for that public key and take all of your funds. So yes, I think change is going to have to occur and people are going to have to rotate addresses and figure out how to adjust and deal with this. But thankfully, it is a little bit down the line. Tomorrow, it's not going to happen. The day after, it's not going to happen. But in the upcoming years, we're not sure exactly when this is going to be a real risk. And given it's going to be a real risk and it's potentially catastrophic and can steal all the funds for everybody, then people should really start thinking about it now and thinking about how to avoid it and avert it.
I think that's a really fair point. It's not something we need to consider right now, but indeed in the coming few years, and there are some other risks as well, they will start to play. For instance, the fact that the Bitcoin chain as itself is very inactive, which makes it for miners a little bit hard to generate enough revenue with the current hash rate. But that's a completely different topic. You're a founder, and being a founder, if I talk from my personal experience, can be quite fun, but it can also be quite challenging. What type of advice would you give to new founders in this space?
It definitely can be challenging. I will say that, particularly I started in crypto effectively when FTX just collapsed. I was building some of the initial projects, and that was a terrible, terrible time to try and sell anything to anybody because everyone was going out of business and everything was disappearing and running out of money. And I think a really valuable lesson that I learned from that is, can you build something which is necessary? It's like a total vital necessity, no matter what market cycle it is, or no matter what people are going to be doing or thinking about. It just needs to be part of their budget. It needs to be involved. Because if you build something which is a necessity, it's going to be much, much easier to survive and to be able to provide to people as cycles move up and down, which in crypto is what happens. I'd say the second thing is keep going. In certain cases, everything's going to feel awful and it's going to feel like there's no ability to do anything. But what ends up happening is that if you are able to stay in the game, new opportunities open up. And so, similar to trading, don't draw down to zero because then you can't take advantage of any opportunities that open up. So even if you see the best trade in the world, if you have no balance, it's not going to work. You need to have the ability to keep going and not tap out, because if you do, then a new opportunity can open up. But contrary to that as well is like know when things aren't working and when sometimes it is possible to change. So keep going in the more broad sense, don't stop, but be flexible and aware that sometimes the original thoughts and the ideas you had weren't actually the correct ones, and be open to market signal that, okay, this is actually the better thing or the more important thing or the clearer thing. And that's ultimately how we arrived on Circuit, is that it was through speaking to these different fund managers and insurers and different institutional players where we realized actually one of the biggest problems that is unsolved is operational risk, that you can still lose all of your money straight away and immediately, and you can't get it back. And that wasn't the original problem I set out to solve. As I said, I was like originally more of a trader, but I realized that this was a massive, massive problem that had to be solved. And so that's how Circuit came about. And then I would say finally, try and help as many people as possible. Because what long-term will happen is that those same people will want to help you, and people pop up in different roles and in different positions, and the people that you help will ultimately be able to help you much, much more than you ever thought of originally, even if you didn't even think that they were equipped to do so. And so be generous, be helpful, and try and do that universally for different people, and it'll come back to you long-term down the line in a much greater way. And even though I haven't been in the industry that long, or in any industry that long, I'm already starting to see the benefits of that from trying to help people as much as possible from day one.
Well, I think that's a very great answer for people that are trying to build something or trying to get a job in Web3, which can also be hard at times or challenging. I mean, it's a very volatile market. If we're talking about jobs, if you weren't building Circuit, what would you have been doing?
So I think there's the parallel path where I continued trading, and I'd probably be working for some form of hedge fund or some form of pod, either doing macro trading or semi-systematic trading, which is a very different life and very different role. I have a bunch of friends who are still traders, so it is kind of interesting to kind of parallel and see what they're thinking about and what they're doing versus what I'm doing. The other parallel would be building something else. I think at this point I have realized that being a founder is meant for me and that I want to build different things. And if I wasn't building Circuit specifically, or let's say for some reason Circuit disappeared in the morning, I would go out to build something else afterwards. I also think I enjoy research, so I publish lots of different things. If people want to check it out, I have a Substack where I publish pieces on different hacks and different pieces of crypto infrastructure. So I enjoy researching and figuring out and learning things. So that would possibly be another path as well.
Well, you gave away my final question. I wanted to ask, where can people follow you or follow the steps of Circuit or whatever is going to be on your path? You mentioned you have a Substack, but are there any other social media channels where we can find you?
Yeah, so we're most active on LinkedIn, just given the institutional audience that we work with. So find me on LinkedIn, Harry Donnelly. Circuit is also on LinkedIn. I think we do have a Twitter, but don't really do very much with it. And so I'm not very actively involved with it. We also have a Substack, which you can access. It's called Risk Frontiers. And that's it for now. There's going to be other avenues and other venues which are going to be opening up in the near future. But to date, those are the main ways that you can figure and find us out. And I'll be appearing on podcasts like this. So check out Michael's podcasts and other ones as well if you want to hear more from me.
Well, thank you very much for this show, for this episode, giving a lot of great info when it comes to security and the way you guys are looking at it. And I'm personally very interested to see how things are going to develop in the coming years for Circuit and for you. I think it's, for me as a fund manager, a venture capital, it's super important to have the operational risk and the third-party risk in order. And I think it's not being discussed enough. So I'm very happy you came on, and I wish you all the luck in the coming year with building Circuit.
Thank you, Michael. I appreciate it. And look, happy to chat after the show. If you want a discounted rate in Circuit, happy to set something up.
Yeah, we'll talk afterwards. Thank you very much.
Cool. All right, Michael.
Thank you.
Pleasure. Chat to you later. Bye-bye.